Paul's first idea is TD Bank. Why is this one of your favorite lenders, Paul?
Well, we've owned TD for a long time. I think the banks in Canada are, as I mentioned earlier on with Bank of Nova Scotia, and they're cheap, in my view at least. You get a 4.6% dividend yield on TD. It's trading at 10 times earnings, 1.4 times book, all things that are, I think make the stock reasonably priced at these levels. So you can buy it here. TD especially has more capital than any other Canadian bank. As you may remember, Andrew, they didn't do their first Horizon deal. They pulled out of that deal, which they're flush with capital. So I think they can actually do another acquisition, buy back their shares, increase their dividend. There's lots of options that they have to do that with. And I think that one of the things that people forget about Canadian banks is that they're not, they're not like American banks, right? I think these stocks sometimes fall because something happens in the United States. They're not like American banks. We have an oligopoly here. We also have very good regulation, which is really important in this country for banking. And they're much more diversified than, let's say, a U.S. regional bank, not U.S. money center banks or U.S. regional banks. Fee income is a much larger percentage of their overall income than what they were years and years ago. So I think it's really important. And TD Bank now is much more diversified geographically as well. They have a large U.S. franchise, a large Canadian franchise. And I think the one risk with any of these banks is what's happened is that there's a lot more variable rate mortgages on their books because what happened with variable rate mortgages and interest rates went up. So that may be a risk, but I think that we have enough regulation in place they can manage through that. And yes, and I think the other thing that Canadian banks, even American banks, have been very good at is reserving enough when they think times are bad. So I think they've done a good job of that, and they have better data to analyze all that stuff. So I think that's one of the reasons I like it. I think if you buy it here, even I know it's up a lot from the graph that you showed, but I think it's if you buy it here, you'll do well over the next several years.
Your next idea is Stryker, the medical device company, medical equipment broadly.
Right. So Stryker is a company we've owned for a long time. We like the medical device area. Stryker makes devices for spines, ankles, hands, and knees, and hips, and a bunch of other things. They make. If you've ever seen any TV show, you'll see their beds are all Stryker beds. So they do have a lot of other products that they make. I think one of the things about this stuff is that you have to remember that these kind of services really improve patient quality of life, right? So getting a hip transplant, a knee transplant, all those things are very important. It improves the quality of life. It also helps the medical system because people are not in hospital for a long period of time with these sort of things. 73% of their business comes to the United States. The rest of it is either emerging markets or developed countries. I think that they have a lot of room to grow internationally because of that. The other thing is that there's a bit of a demographic play here because as people get older, they need more of these kind of surgeries. So you kind of embed that into their growth. And also there's an annuity because most surgeons tend to use these products. They don't switch between products all the time. They tend to get used to one product and they tend to use that product. So I think they've got lots of free cash flow. There was a backlog of businesses and of operations because these were considered elective through COVID. So there's a backlog. That backlog is being decreased over a period of time. But I still think there's a lot of growth in here as the population gets older. They need these products. And also because of their great free cash flow growth, they can actually go in and buy other companies in this area, which I think they will continue to do and grow internationally.
And your final idea is Enbridge. You're confident in the dividend, I take it, Paul?
Yeah, I am. I think the issue with Enbridge is that, Enbridge is a energy services, energy transportation, energy distribution business in this country. Obviously, in the pipeline business is one of what people really know them for, but they're obviously involved in other businesses. It pays about a 7% dividend yield, a little bit more than 7% dividend yield. I think the stock fell because of their Dominion Dominion Energy acquisition, which they made. They had to issue a lot of shares to do that at a discount to the market. And so that hurt the company. But I think it was a very important acquisition for them because it reduces their kind of more cyclical businesses and brings them more in line with being a kind of utility. And so I think that's really important. I think one of the things you have to remember about this business, though, is Enbridge is really much more of an American company in many ways, I think, down the road, because they made two acquisitions in the United States, two reasonably large acquisitions. I don't think they feel comfortable being in Canada because they can't execute on a lot of projects that they want to here because it takes so much time, and I think they've just decided that their lot really lies south of the border where they can get a lot of this stuff done. So I think a lot of the stuff is in the stock already, all the bad news, and I think you get a good dividend yield which they can manage. It's not going to go up as much, but I think you have a good chance of owning the stock here and doing well with it.
First idea is Brookfield Corporation.
That's right, Andrew. This is one of the world's foremost managers and operators of long-duration real assets. So asset classes like real estate, private equity, infrastructure, which we just talked about, renewable energy, utilities, and increasingly insurance as well, actually. And it's got a great geographic footprint. They've got assets in the United States, in Canada, in Australia, India, Brazil, the UK, just to name a few. So tremendous reach and a lot of depth of talent on the ground in each of those countries. And so their size and scale, plus the diversity of funding sources they bring to the table, make them one of the first calls that sellers of world-class real assets will make when they're looking to consummate a transaction. They're also an asset manager, so not owning these assets just as principal, but in funds on behalf of pension funds, sovereign wealth funds, and increasingly high net worth households. The beauty of that is it's capital light, way to leverage their operating expertise, and flows of funds into these alternative asset classes are stripping flows of funds into stocks and bonds by leaps and bounds.
Even with the rise in interest rates.
Yeah, I mean, that may have gated it somewhat on the part of pension funds, insurance companies, because when interest rates were really low, these long-duration assets were a very good match for their long-duration liabilities. Now bonds compete for capital a little bit better. But what's stepping in place of some of these pension funds and sort of asset liability matchers is high net worth households. And they're just hoovering up cash, I think $10 billion in the latest quarter alone from private households. So, that's a secular force. And all of this is rolled up and allowed Brookfield to compound shareholder returns, total returns, at a 15% pace over the last 25 years. And the math on that, Andrew, is a dollar invested in their shares back in 1998 would now be worth over $31, courtesy of all these structural advantages they have.
Okay, that's including dividends and stuff like that.
Exactly.
Yeah, reinvested. Your next idea is the snack giant Mondelez International.
Yeah, so Mondelez is an international packaged foods company. It's headquartered and trades in the United States, but very global in scope. A big player in snacking categories like biscuits, chocolate, gum and candy, and to a lesser extent grocery and cheese and beverages. The brands that they own are nothing short of iconic, so Cadbury, Oreo, Trident, Tang, Toblerone, just to name a few. And so it enjoys sort of category leadership and very strong pricing power, which has been very important amidst the period of high food commodity price inflation. They've been able to very easily pass that through, taking price increases in the mid-teens or higher in some geographies and categories as needed, without giving up too much volume. They over-index to rapidly growing emerging markets, Latin America, for instance, India. So that's part of the growth algorithm. And so this stock yields 2.4% right now, and it's grown its dividend at a 13% compound rate over the last decade. So we put the two together, and we see a pretty good and highly visible defensive path to a low double-digit rate of return over a cycle with this company, which is very, very non-cyclical, very resilient, very dominant in its categories.
I mean, such a collection of brands. Cadbury Dairy Milk. I don't know if that's all of Cadbury. I suspect it might be. They've got Philadelphia cream cheese. They've got Tuck crackers. You name it. Wheat thins. Yeah,
Well, we conducted a little impromptu research at my office last Friday, Andrew. I had a meeting with their management team in Toronto last Thursday. So decided we should do some hands-on research and sample some of those fine brands, and the verdict was good.
Okay, we've got less than 2 minutes. Constellation Software.
So Constellation Software is a software holding company that acquires mission-critical vertical market software companies and helps them to grow.
Yeah.
Vertical market software, just to define the term, is sort of at contrast with horizontal market software applications like Excel or PowerPoint or Microsoft Outlook that can be used across all industries and sectors of the economy. These are narrow applications that you need to run a vet clinic or a golf course or a restaurant or something like that. Their unique operating model, the companies that they acquire, they equip them with best practices, procurement, and shared services efficiencies, but allow the founders in many cases to make grassroots decisions in the best interests of their operating unit. Mm-hmm. This is a company that is notoriously tight-lipped, even you might say non-communicative with investors. They don't hold conference calls, don't do analyst days.
Yeah.
So very old school, but their results do the talking for them. It's compounded earnings at a 25% pace over the last decade. Trades at 29 times earnings, so we see a good combination of value and growth in these shares here.
Brian, thank you very much indeed.
Great to be here, Andrew.
First idea, precision drilling.
This is a new one. For anybody that's followed me, we've been anti-oil and gas services for well over a year. This is our first services name that we've had in the fund since that time. We were bearish on services because we thought that as oil price and gas price were going up, that the focus on return of capital would mean that CapEx wouldn't go up as much as historically. We were proven to be correct. The stock is down 25%. It's fallen to a level that we view as extremely attractive. What's kept people on the sidelines with precision drilling has always been their balance sheet. They were at almost 4 times debt to EBITDA, or debt to cash flow, not that long ago. They've been focusing very disciplined, maximizing free cash flow, similar to producers, and deleveraging. So we have them reaching 1 times debt to EBITDA this time next year, which is just a radical transformation of a business. And where we've made good money on the oil and gas producers is when companies reach that inflection point, when they finally reach debt targets, and they'll pivot from using money to delever to rewarding their shareholders for patience over the worst bear market in history. We have that happening for precision drilling by the end of Q2 of next year. And so when we look at this name, and I talked to the CEO this morning, so I feel decent about our numbers. We have them trading at a 34% free cash flow yield next year, rising to a 36% free cash flow yield the year thereafter. And this is a non-depleting business. This isn't a company like Vermilion. You got 3 years or whatever, inventory, and you got to do something about it. These are very low-ish maintenance assets.
Don't the rigs kind of wear out?
They do. Yeah, so we're accounting for maintenance capital in that free cash flow number. Yeah. So I look at it. Well, I can buy into a solid business with the backdrop of LNG Canada, the necessity to replenish an exhausted, drilled, and completed inventory both in Canada and the United States. So pretty good macro headwinds where we've got it trading at 2.8 times next year, falling to 2.1 times the year thereafter. So we think, let's say a 14% free cash flow yield target. That's 5 times EBITDA. That gives us over 100% potential upside. Gives us a $177 target. And I think Wakir from ATB, I think his price target is close to there. So it's not just, we're not the crazy guys with that estimate. We think it's reasonable. So it's, again, in terms of a service name, a non-depleting business, rapidly deleveraging, trading into 36% free cash flow yield. They'll soon have such a strong balance sheet that they'll have a cash problem. They won't know what to do with it, and it's going to come back to us, we hope, in the form of buybacks plus a base dividend.
Yeah, no dividend right now.
Not now.
Yeah,
no.
Okay. Crescent Point Energy, they announced that big acquisition, Hammerhead.
They did.
It sold a bunch of shares.
And what got hammered was the share price from that. And I think people are confusing a bad deal for bad timing. We think it was a good deal with horrific timing because they did a $500 million bought deal the night before oil fell $3 the next day, which of course no one's going to participate with oil falling $3. The deal gets hung. The syndicate got that taken care of. I think the deal price was $10.75. The cleanup trade, I think it was $9.75, $9.80, somewhere thereabouts. So that's clean. What I like about it and what people confuse is we're pro M&A. It's not against our playbook of maximize free cash flow, using it for buybacks and dividends if they so choose. M&A is good if it allows them to pay us more, next year. So we had this deal being 11% accretive on a free cash flow per share basis, meaning we're still going to get our 60% of free cash flow next year, but we're going to get 11% more for every share that we own. Plus, it extended their premium inventory life from 15 years to 20 years. I saw Craig in my office, I think it was Thursday of last week. He promised me, I said, Craig, I'm going to BNN, I'm going to quote you. He said, we are done. And for the first time,
What do you mean? Sorry.
M&A. This is
Craig
it.
Bricks, the CEO.
So they're done.
Yeah.
So this is not the Crescent Point of old, empire building, all this stuff you see on Twitter. So you've got a company now with 20 years plus of premium inventory, paying us 60% now. They're now communicating that 60% is going to go up as they pay down debt. So we're going to get 60, other 40 delevers. We've got it trading at 3 times cash flow, a 25% free cash flow yield. We put a 5 multiple, we get 75% potential upside 1 year out at $80 oil. And we were buying after the deal. We bought another 1 million shares at 10.03. So I think we're the number one active shareholder now. We own 19 million shares.
Synovus.
So this one has been disappointing for people because we were supposed to, by this time, they were supposed to reach their final debt target, $4 billion. We're supposed to be getting 100%, using it for buybacks, drive the re-rating. That took longer than we thought because oil was weaker than we thought this year. They had working capital, weird stuff that I won't bore people with. They had downstream issues. Everything's been fixed. So now we're just waiting, for them to hit the $4 billion. We have that happening in Q2 of next year. So we're getting 50% now. We're going to get 100% of free cash flow next year, early-ish, so you can look out. With the stock trading at a 16% free cash flow yield. So theoretically, this is a company by, let's say 6 months from now, on an annualized rate, they could pay us a 16% dividend and keep their production flat for the next 35 years. We think this sector trades down, gets re-rated to a 10% free cash flow yield. That's a 6 multiple. For Synovus, that's a $37 target 1 year out, a $43 target 2 years out, offering 40 to 80% upside in a large cap name with a super strong balance sheet, 35 years of stay flat inventory, a new-ish CEO whom I know quite well, and I respect him. He's a very solid, steady hand.
Right, and a low cost relative for their production?
Yes, they have 2 of the highest quality reservoirs, Christina Lake and Foster Lake, of any SAGD operation in Canada. So I don't see why this should trade at such a massive discount to either C&Q or to U.S. peers. And I think next year a big theme is going to be the realization, shale, let's say shale production is roughly 13.1 million barrels per day. Now we're U.S. production. We think that's close to a peak. That should be falling off with massive declines now and the rig count continuing to fall-ish. We think next year production growth is going to be maybe 400,000 to 500,000, so half of this year. But there's going to be a realization that these shale companies have an inventory problem. They have less of it than people thought, and the quality of that is eroding. We can see that in real time. And as people get more bullish on oil, it's not today, but it's going to happen, the value being placed on long-dated reserves will go up. And outside of Saudi Arabia and Venezuela, we are blessed, we are gifted with the longest dated reserves of anywhere else in the world. We have TMX coming online Q1-ish of next year. So the era of super high differentials will finally be over, and these names are going to spew free cash flow.
Spew free cash flow.
And we're going to get it all soon.
On that note, we better leave it. Eric, always great having you on the show.
Thanks so much.
First idea, Loblaw.
Yeah, so Loblaw, food retailer and drugstore retailer, why we like it. We've had this name for a number of years, and I consider it kind of a very defensive consumer staple stock. So we're going into an economic environment that it's softening. We're not quite sure how it's going to play out in Canada next year. So on the food side, over half of Loblaw's food banners are in the discount segment, so think of No Frills, and they actually are seeing that there's more and more traffic gravitating to the discount banners because the consumer is feeling a little under pressure. So that benefits Loblaw. And then on their kind of market or premium banners, like the Loblaw banners considered that, they're starting to notice maybe people are kind of buying a bit more groceries or meal kits in their market banners instead of going out to eat all the time because once again, pressure on consumer spending. So, the discount banner is benefiting them, their presence there. And then obviously on the drug retail side, we really like the drug retail side. Shoppers Drug Mart, the largest drugstore chain in Canada, very good locations. We're seeing that the pharmacists in general, are getting permission to expand their scope of services. In Ontario this year, pharmacists can now write prescriptions for, kind of more common ailments without you having going to a doctor to get a script. So that means that they're driving traffic into the shoppers' stores to pick up the prescriptions.
Yes.
And that means also traffic to be able to shop on the front end, which is all the cosmetics and all that stuff, cough medicines that they can buy. So that drives traffic in. And it's convenient, too, to go into a Shoppers because, and then they've, I don't know if you've noticed, Annie, a lot of these Shoppers stores, they'll actually have Loblaw food offerings on the side, like fresh produce, some of their products. So that's convenient. So, and then as well, finally, an indirect way also, I guess, to play on the increasing population in Canada.
Otis Worldwide is your next idea.
Yes, so a leading elevator and escalator company. They're actually the number one with about 19% share in new equipment. We like Otis because, it's very global. Over 70% of their operations are outside of North America. New equipment, the service side is particularly very attractive, very high margin. It's about over 55% of its revenues, but over 80% of its operating profits, because the margins on the service side is about 3 times that on the new equipment side. So the service side is when you buy the elevator and then you buy the service contract related to it. So you need to always maintain it, repair it over time. It's kind of like the engine of a building. And so when this company was spun off at United Technologies in 2019, one of the focuses was to increase the conversion rate to get, when a customer buys the elevator, to buy the service contract. It's about 60%, and they've been increasing that over time. And as well, the installed base of the elevators is aging, but a third is over 20 years old now. And when it gets to that age, that's when you need to really start thinking about modernizing and replacing it. So that's going to be beneficial for Otis. And it also pays a dividend, not that high, but we consider it kind of a long-term attractive growth stock.
And then Royal Bank.
Yeah, we didn't talk about banks this show.
No, that's
unusual.
Funny. Yeah.
And we actually think the Canadian banks, they're reflecting a lot of the potential bad news in the Canadian economy.
Okay.
We like Royal because, it is quite large. And we like the fact that, the HSBC acquisition, which has been approved by the Competition Bureau, still needs approval from OSFI and the Department of Finance. But the company is hoping to close that by the first quarter of next year. I think that's going to add to their long-term growth in terms of, new customers into their system. It's diversified. I think it's trading at a pretty attractive multiple at about 10.5 times earning and 1.4 times book. The yield is just over 4%. The banks start to report next week. I think loan loss provisions will continue to climb up a bit higher, but I think they're very manageable. The Canadian banking sector is very highly regulated, so it's actually been beneficial for the industry. And once again, we like that dividend yield. We think that we actually may see another dividend increase when the Royal reports their fourth quarter.
The Bloomberg had that good story yesterday about the problems, the lack of profitability at City National, the LA bank that they bought.
Yeah, I mean, it's a bit more difficult, the U.S. banking system. I think things should start to stabilize and hopefully start turning around pretty soon for City National.
Right. And I guess that could be an overhang until they fix it up.
Yeah. They've been putting some capital in there, but I think long term, when they bought it was for they were in a very attractive geography, and I think that should work out in the long run. Yeah,
it looks as though many of the wealthy customers just pulled out their deposits
and bought longer,
and
that's the thing that's been happening in the U.S. banking system, and it's been happening in Canada as well. And Burrell actually thinks that a lot of that is behind them now.
Christine, thank you very much.
You're welcome.
Let's get to these top picks, and they have got a theme, an infrastructure theme.
Yeah, industrial/infrastructure theme. Yes.
Eaton is your first idea. Remind us what they do.
Well, they're primarily a power management company. They feed into electrical systems, hydraulics, car parts, so engineered parts for the industrial world. And I've talked a lot today, I think, about companies on valuations that are trading, in the low to mid 20 valuation of price to earnings. But I've shied away because they're just not growing as the fundamentals aren't growing enough to support those valuations. In Eaton's case, I believe they are. So it does trade in around the 22, 23 times earnings level. But it's trading, it's growing rather very smartly. Grows revenues at 10 to 12% per year. Grows earnings at a faster rate than that. Their Electrical Americas business is growing around 15% per year. So we think this is really a great balance between growth and value. It's a good place. And I talked about the infrastructure theme earlier. $2 trillion has been allocated, and most of it, the vast majority of it, has not been spent. So it has years of legs.
Yeah, it's interesting. I mean, when you think about a new subway line or something, the amount of electrical stuff that has to go in, or a streetcar line, Fluor, another long-standing player in engineering.
Yeah, this is more of a project manager, engineering company. We own another one, MCOR, that I've talked about on the show a number of times and has done extremely well for our clients. We think that the theme is the same here. Fluor's got a little bit of a spotty past. There's been some mismanagement in the past, and we think that they've righted the ship. We've spent some time looking at the new management group, what they're doing. We've given them a period of time where we've looked at them, and we think this is a good opportunity. Trading at, I think, 14 or 15 times earnings, growing well, and again, coming back to the infrastructure theme, huge backlog and growing.
Small world, just at the start of November, they said they'd been selected by BHP to develop stage 2 of that huge Janssen project.
Okay.
Yeah. Wesco International, a distributor of electrical and communication stuff.
Right. So not a manufacturer, a distributor out of Pennsylvania. Trades very inexpensively at around 10 times earnings. But one would expect that a distributor would trade a little bit lower than a manufacturer, less flexibility in terms of margins, more competition. They recently a couple of years ago, bought a company called Annixter, which is a company that we owned as well in our small cap portfolio. We like the space. And they're growing well and are right size from a valuation standpoint.
Right. What about the multiple? I know the multiple on Fluor about 14 times.
Right.
Wesco about 10 times.
About 10
As you
times.
say,
Yeah.
It's not going to. Because you're not making and servicing the stuff necessarily yourself.
Right. I mean, there's really only so much pass-through cost that you can charge.
Yeah.
You're a facilitator as opposed to a manufacturer.
And growing market share. Yeah. That elevator business sounds sweet. A fellow I know was involved in the management corporation of a condo building, and his impression was there's an oligopoly of elevator companies. It's pretty tough to save money on that. Thank you very much, Gordon.
Thank you, Andy.
Gordon Reid.